Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are working to make work optional, and we are doing that through stock and crypto passive income, sharing our journey with you. One of the best ways that we have found is through dividends. Quarterly dividends are great, but what if I told you that there's a fantastic company that pays monthly dividends, allowing you to compound your money even faster, at an even faster clip than you normally would? Would you be interested? Well, we're going to talk about that company right now. For over 20 years, I've been working in the industrial sector around the Chicagoland area, working in warehouses, on loading dock equipment, sales, installation, service, doing it all. And what I have been seeing a trend of is e-commerce. So this company is helping to facilitate e-commerce, getting from producer to you and I through the internet, and that is STAG. So who is STAG? I am STAG. Fact, when I was in high school, they used to call me super tall athletic guy, STAG, not fact. So STAG Industrial, ticker STAG, is a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. By targeting this type of property, STAG has developed an investment strategy that helps investors find a powerful balance of income plus growth. Single Tenant Acquisition Group, or STAG, is a REIT. That means they have to pay out 90% of their profits in the form of dividends, but the flip side is those dividends are going to be taxed as your ordinary income tax rate. There's no special tax break on those dividends. But that's okay because STAG pays a monthly dividend. That's right, your money's going to be able to compound faster. Now, as dividend growth investors, we are looking for profitable companies with really good business economics, and when you find those companies, the share price will follow. 2020 with the COVID pandemic was a stress test, and we looked for companies that were able to pass that stress test with flying colors, and we feel that STAG is one of those companies. During 2020, they hiked their dividend 1%, which they have been doing since 2016, as you can see on the chart. They also increased their earnings per share a whopping 278.2% to $1.32 per share in 2020, which is good for a 77.7% annualized 3-year growth rate. Hey, that's great. Their sales increased 19.1% in 2020 to $483.4 million for an annualized 5-year growth rate of 17.2%. And much like Shakira says, these hips don't lie, with companies, their cash doesn't lie either. So there's no fibbing here with STAG as their cash flow grew, grew 49% to $2.86 per share, which is good for 42.8% annualized 5-year growth. STAG is all about acquiring those single-tenant properties in secondary markets. Now, I know you know, but other people that are new here might not. Single tenants occupy the entire space. And as the CBRE article points out, that it is commonly thought that an e-commerce supply chain requires up to 3 times more warehouse and logistics space than a traditional brick and mortar supply chain. Now, as you'll see, 40% of STAG's tenants are e-commerce related, and as CBRE pointed out, that 3 times as much space is required for logistics than with the brick and mortar supply chains. So e-commerce is growing. 40% of their tenants are already e-commerce related. This is going to be a fantastic driver of growth for STAG going forward, we believe. Jumping on over to Simply Wall Street right now to look at a few metrics. 1-year return of 36.5%, and the 5-year total shareholder return with dividends is 109.6% compared to only 54.5%. So they are doubling up the industry. Looking at PE ratios, remember, it's always better to compare the company against its own sector or against its own 5-year or 10-year history. And in the case of STAG, they are at 37 times earnings against the industry, which is at 47, making them a good value compared to the industry. Analysts expect the earnings to take a dip going forward, but the revenue is just on a nice straight upward trajectory. Analysts only expect a 1.6% annual earnings growth going forward, but Nobody has a crystal ball, so take that with a grain of salt. Looking at their past performance, STAG was not profitable. Check that out. In 2016, they were negative 13% profit margin, but fast forward to today, 31.2% profit margin. That gets the big thumbs up from us all here at Dapper Dividends. Past 5 years, they have just crushed the industry, 53.3% compared to only 9.9% in the industry. They do have a very strong balance sheet with the short-term assets outweighing the liabilities and the long-term assets easily covering the short-term liabilities. Debt to equity ratio was in the 70s, and we are currently at 69.1%. We'd like to see that a little bit lower because obviously with a higher debt to equity ratio, it means that companies are financing growth with debt. But I always say it, you've heard me say before, not all debt is created equal. With that being said, let's take a look at the interest coverage ratio to see if STAG is able to cover the interest on their debt. Okay, check it out. So STAG's current interest coverage ratio is 2.25. That means they have $2.25 of operating income to pay every $1 of interest expense. I usually like to see that number above 5. But if we look at the industry, we see that it is 3.39. So they're a little bit low there. It could be higher. And a company like Realty Income is at 2.81 currently. A lot of the REITs are going to have a lot of debt. So this is not a huge worry, and they are able to pay the interest on their debt, and they're in line with most of the other industry. Now we're buying for the dividend, which is currently at 3.76%, which is a very nice starting yield. Remember, they do pay every month, and the industry average is 3%, so they're beating the industry average. They've been paying that dividend since 2011, and they have consistently increased it. They have never cut. That is a fantastic sign, and as we remember, they have been increasing it 1% since 2016. Current payout 79%, but remember that REITs have to pay out 90% of their profits in the form of a dividend. And I love to look at the ownership breakdown. 87.9% of institutions are holding STAG compared to 11% for the general public. And they have issued shares in the past, but remember, Realty Income also has issued shares. This is how companies get more money. They issue shares, they bring in more money, they can acquire more properties, and they can continue to grow. So in the case of REITs, I'm not too worried about a little bit of share dilution. And a couple of things I'd like to point out from the spring 2021 presentation. They're the only pure play industrial REIT active across the entire domestic industrial real estate market. I love that they don't have any retail or office spaces. They are pure play industrial. Check out some of the growth from their IPO in 2011, from 14.2 million square feet to almost 100 million square feet. 93 properties to 494. Keep in mind, this is in 10 years, people. 26 states they had a presence in, up to 39 states. The flex in office space, which is what is not a good thing to be in now. We're seeing this with Realty Income spinning off. Check out the video I did here about Realty Income with their merger with VEREIT. They're trying to get out of office / flex space, and they went from 21.1% down to 0.6%. This is a fraction of their portfolio, and in no way is this a core holding. As we talked about earlier, 40% of the portfolio handles e-commerce activity. Look at that. In 2012, only 5.6% of e-commerce was a percentage of retail sales in the United States. Today, 14%. It's only going up from here. They have plenty of room to grow. There's $1 trillion total in the industrial market. Their share is only 0.5%. They're teeny tiny, and they're going to grow to become a powerhouse, I think. Now, their acquisition pipeline in 2021, we can see, has taken a big jump up to $3.5 billion. And in 2020, check that out, the year of COVID, they had 224 transactions they underwrote and 39 transactions closed. 61% of their tenants have a revenue of greater than $1 billion. And who's in their tippity top of the top 10? It's Amazon. Fantastic that they have that partnership and relationship with Amazon that hopefully they can keep expanding and growing on. And then second is XPO Logistics. They are a trucking company. You see their trucks all over the place. And two more companies that stand out are FedEx at 1% and WestRock. WestRock is another dividend-paying company that handles cardboard boxes. They also make boxes for Amazon. And my sweet home, Chicago, is the #1 market for STAG. Check that out. Some of the top companies, it's the nation's premier freight hub. I know this is what I work in. This is what I see every day. Fresenius Kabi. Diageo is the liquor. Target. Excel Logistics, Expeditors. I've worked for both of those in the past. Market #2, Philadelphia. Check out their recent tenant activity. Amazon, UPS, Kellogg's, FedEx, Tesla, Starbucks. The who's who of dividend companies and the who's who of some of the biggest names on Wall Street. Market 3, Greensville, Spartanburg. Shows they have a BMW plant, so they have some pretty big names under their belt that they are working with. A couple of the potential risks for STAG. #1, higher interest rates would mean higher cost of doing business. It would cost more to borrow money, which would make it more difficult for STAG to acquire property. Increased competition would mean increased bidding, would mean lower cap rates for STAG. And general economic weakness. If the economy takes a dump, that could negatively impact many of STAG's tenants. At the recording of this video, STAG is around $38, $39. But as dividend growth investors, I think STAG is going to be a force to be reckoned with. They're going to keep growing. I'm very comfortable buying here because I think in 5, 10, 15 years, this will look really cheap. Plus, you can start compounding those dividends immediately. And I think if they pull back into the low 30s, the high 20s, then I'm going to back up the brinks. I'm going to be loading up more STAG for us. And you're not going to get out of here without looking at the Simply Wall Street valuation. The fair value that Simply Wall Street has is $83.11, making STAG Industrial about 53.6% undervalued from the current price of $38.58. We touched on a lot with STAG, and that literally is just scraping the tip of the iceberg. But for brevity's sake, I wanted to get out some of the main points to highlight why we are such big fans of STAG and why we are happy to add them to our dividend growth portfolio, buying the companies that will one day pay us money to make work optional. Let me know what you thought of this video. Do you own STAG? What do you think of STAG? Do you think they are indeed a dividend cheat code? Follow me on Twitter at RustyRam78. And again, if you didn't get it before, check out this video right here that we did on the Realty Income proposed merger with Viddyoze. These are two fantastic companies, Realty Income, ticker symbol O, and STAG. Check that video out, and I will talk to you there.